Will the mortgage rate go down in 2023? That is the question that everyone's asking. Mortgage rates have such a big impact on our lives because housing is the biggest expense in your life. We're gonna answer that and more right now. There's a lot of information in this video, so stay with me as we go through it. And don't forget, like and subscribe. Today we're starting off with a history lesson on mortgage rates. So let me pull down my chart. In 1970, mortgage rates were at 7 to 7.5%. Not crazy far off from where we are right now. And within 10 years, to the 1980s, it spiked at 18%. That's 11% growth in 10 years. And things were quite difficult. If you talk to anyone that bought homes back then, it was a lot more expensive than they were used to. So it went up, and then since the 1980s, all the way until 2008, it's been coming down. It has almost taken 30 years to get back down to 6 to 6.5%. Now, of course, the chart looks like this and not a straight curved line. Straight curved? Is that a thing? But regardless, 6 to 6.5% in 2008. We all know what happened in 2008. Things crash. Along came down the mortgage rate because they wanted to spur the economy, and it worked. They brought the rates all the way down to in the 3s, and it was great. You could buy a larger house for the same price. Now rates started to go back up a little bit, right? But not crazy. We're back to where we are now over the last few years, and we remember this because it's recent. We got as low as about 2 to 2.5%, which is the lowest of the last 50 years. It is completely unheard of. In fact, outside the last 15 years, since 2008, the rate has not even gone below the 6s. So all the rest of those years is well above what we're used to. Now, it's fair to say that the mortgage rate still feels high because we've come from 2.5%, but technically, today's rate is in the mid to low 6s, very close to 2008 and very close to what it was 50 years ago. So it's definitely not uncharted territory. But now that the history lesson is over, let's talk about what affects mortgage rates. The first one is the economy as a whole and unemployment. If people have jobs and they think they're gonna still have a job, they're gonna feel secure. And they're gonna go out and buy houses. And banks that give loans to these borrowers are gonna look and say they're very likely to have a job still. In fact, they're probably gonna get a raise. They wanna give out those loans, and that gives downward pressure on the interest rates. Now let's flip it. Unemployment goes up. Right now, we just heard Google, Microsoft, Carvana, Amazon, they have all let go thousands of people. But as employment goes up, interest rates tend to be pushed up because things are less stable. And when the bank tries to give a loan to a borrower, they're unsure if they're gonna get paid. They're unsure if that person's gonna have a job. And of course, they probably don't expect any raises. The economy plays a huge role. The second thing is inflation. Inflation is the price of everything getting more expensive. We've had a lot of inflation over the last couple of years, and as that goes up, well, how much is left in your pockets to go out and spend it on the things that you need to? When you buy a house, they calculate how much disposable income you should have and how much of your income your mortgage is allowed to be. Well, if that other space gets bigger and bigger because of inflation, all of a sudden you don't become the best borrower.
You are poor.
And people have a harder and harder time buying houses. Inflation does put pressure on mortgage rates to go down so that people can afford these houses. And then the third thing is the Federal Reserve itself. This kind of goes with inflation a little bit in our brains because every single article you read has both words in it, but the Federal Reserve, as we know, doesn't like inflation being too high, and they are going to change the Federal Reserve rate to either try to grow the economy or contract it, which is partially what happens with inflation. So right now they are increasing the Federal Reserve rate, which is basically how much it costs banks to give out loans. If that goes up, yeah, they're gonna charge you more for your loan, which means mortgage rates go up, inflation goes down. And that's exactly what we're seeing right now. Inflation was at almost an all-time high, and now it has come down dramatically. Now, let's talk about what I predict will happen in 2023. First of all, the economy and unemployment. Like I said, Amazon, Google, Carvana, a lot of these big companies have just let go thousands and thousands of people. I think personally that's just the start. I think we're about to see a lot worse things happen by the end of the year. That means more unemployment, more risk, which means upward pressure on the mortgage rate. What do I think is going to happen with the Fed? Unlike other people, I think the Fed is going to keep raising the rate a few more times. People are really hoping next week is the last time. Now they are going to be smaller increases, but I do think they're going to happen several more times. So each time that happens, understand that's upward pressure on the mortgage rate. And lastly, what do I think is going to happen with inflation? There is such a strong connection with the Fed increasing its rate and inflation going down that I think inflation is going to keep going down towards the end of the year. So we will be in a lot better spot with inflation. Now, at some point, the economy might get so bad, just like after the 2008 crash, I said they had to spur the economy. When that happens, things are gonna change. But you need to be smart, know your stuff, and get through these parts. That's what I think is gonna happen. But what should you be doing? If you go out and buy a home right now, how can you get your interest rate lower? What strategies can you put in? Because prices have come down 10 to 20%, and mortgage rates are not as high as I think they might get. But by the end of the year or in a couple of years, interest rates should be lower, in my opinion, than what they are today. First off, you can refinance. You can go out and buy a home today, get the discounted price, it's 10 to 20% off, and then refinance when the rates come down. Number two, you can use things like rate buy downs, where you spend a specific amount of money and kind of prepay interest to where you know you have a lower payment now for a couple years before it goes up, which allows you to refinance. And then lastly, you could use other strategies like an ARM, an adjustable rate mortgage. These can be very good and they can also be bad. So know your stuff. Know your situation. Don't just walk into these blindly, because a variable rate mortgage means it's not staying consistent. It's going to change based on the economy, which could really work out in your favor, but it could also screw you over because it's uncontrolled by you. Look at all your options, including alternative ways to buy. This is always a fun topic to talk about because a lot of people that don't qualify for loans can use these strategies to qualify. So let's talk about them. First of all, you could do a rent to own or a lease option. If you're going to be renting for a couple years and then you want to buy, you should strongly consider this. Do I think the houses are going to be more expensive than they are today in 3 to 4 years? I absolutely do. If you do a lease option, you could be renting the whole time. You do have to pay an option fee to lock in that price, but then you could buy the house a couple years from now at today's price. So strongly recommend for the right people. Now you could also do seller financing. This is such a cool thing because you're working directly with the seller and they're not really regulated. So you could say, oh, well, what's the down payment? What interest rate? What monthly payment? If you go to a seller and you can lay out all your financials and tell them, this is me, let's try to work something out. You don't have all the dumb hoops that the bank's gonna make you jump through. And they can verify as much as they want. A lot of times, entrepreneurs and business owners use seller financing. Now, kind of a hybrid of this is going to be the last one, which is a wrap. Because we talked about the history of the mortgage rate, and what was the mortgage rate 2 or 3 years ago? In the 2s, pretty crazy low compared to the mortgage rate today in the 6.5 to 7, right? So do you think there's enough margin in there that someone that has a loan at 2.5% could give you a new loan and wrap the old mortgage? So they could charge you more than 2.5%, but less than the bank, which means your monthly payment could be more than theirs, but less than the bank. You could put things in the terms like balloon payments and other things. So these alternative options can be really cool for those that can't qualify, but I can also recommend them to people that can go get a bank loan. Try to get yourself the best rate you can and in the best situation possible. So we've talked about the history of the mortgage rate, what affects it, what I think is going on with 2023, and then on top of that, we talked about strategies you could use and alternatives for even those that qualify for a bank loan. If you guys like this type of content, like and subscribe, hit the bell. We have more. So until the next one, peace.